If you're struggling to make money as a trader, in today's video, I'm going to be showing you how you can make your first $100,000 as a trader. I'm going to break down everything you need to start doing right now. And I'm also going to be breaking down my entire strategy from start to finish for completely free. But real quick, if you guys do find value in today's video, as always, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. But without further ado, let's hop into the video. Step one, and the most important, is full port 0DT SPX calls. That's a joke. Don't do that. But I want to start off the video and give you guys a nice little laugh. Now, actual step one. Start small. I see a lot of people come into the market thinking that they have to start trading with $5,000, $10,000, $25,000. But if you are brand new to the market, why would you start trading with that much money and risking that much potential money when you could be using that money instead to invest in your education? So I always recommend a new trader start small. That way you're not risking a substantial amount of money right off the get-go. And also, there's no reason to be using a big size as soon as you start trading. If you're brand new to the market and you're trading options, why would you go and buy 10 contracts? If you're brand new, only start with one contract. You're not going to make a lot of money at the beginning, but this is a brand new skill set and you have to put in the time and effort to actually get good at this. It's not as simple as coming in, putting 20,000 into a position, oversizing, and making a bunch of money. Because 99% of the time, you're going to lose money if you do that. Unless at 1% of the time you get lucky. Now, step number two, you need to find a strategy. And like I said, I'm going to be breaking down my entire strategy from A to Z later in this video. Now, step number three, risk management. Risk management is arguably the most important in our trading journeys. Because without risk management, we're going to lose all of our money. It doesn't matter if you make $1 million trading. If you don't have risk management, you're going to lose that $1 million. And trust me, I've seen a lot of traders make a lot of money, but because they don't have good risk management, they lose it plus more. So as traders, we need to learn to accept our losses quickly. As soon as the trade hits our stop loss, we're out. Or if we're in a trade and it starts showing signs that it's not going to work out in our favor, get out of the trade. Because as you can see at the bottom of the screen, I would rather take multiple 10 to 20% losses than two big losses. So again, we need to learn to accept that we are wrong quickly, get out of the trade, and look for a better setup. And also, you need to learn to accept the fact that you are going to be wrong in the market, and you're going to be wrong a lot. Step number four, you need to let your winners run. Now, I see a lot of traders who struggle with this, and a main reason why traders struggle to let their winners run is because when they're in the trade, they start thinking that the trade's going to go against them and that they're going to lose money. And as a result, it makes them get out of the trade early for a terrible risk to reward because they faked themselves out thinking that the trade was going to go against them and that they were going to lose money. I know everybody watching this video has been through it. I've been through it myself. So stop thinking of the potential loss because also that can keep you from even entering the trade. So making you hesitate and not take the trade and just watching it do exactly what you wanted it to do. But when you're in the trade, stop thinking the trade is going to go against you because as a result, you're more than likely going to sell early and miss out on the larger move. Now, when you're actually in a trade, an A+ setup, using a strategy that you have found to be profitable, you need to focus on the price action and the price action only because price action is going to be your best friend as a trader. Price action is going to tell you if the trade is going to continue to move in your favor. Price action is going to tell you if you should get out and book your profits right now. But if you're letting outside noise and your thoughts scare you out of a trade and not focus on the price action, you're going to miss out on a lot of potential profits. And the real way to grow your account is by letting your winners run. And then finally, step number five is slowly increasing your size. This is another thing that I see a lot of traders struggle with because they'll get good at trading, let's just say 2 or 3 contracts, and then they'll instantly jump up to like 10 contracts. You're not used to that size. And because you're not used to that size, you're going to make a lot of mistakes. And guess what? If one trade goes against you because you just tripled your position size, you're going to take a very big loss. So if you were trading consistently with 2 to 3 contracts over the last couple months and doing good, as soon as you jump up to 10 contracts and you take a few big losses, you could potentially wipe out all of those gains from those previous months because you sized up too quickly and you started making mistakes. So you have to earn your size as a trader. Slowly size up over time. My biggest suggestion to all traders is when you start sizing up, only size up by 1 to 2 contracts until you become consistent with it. So if you're trading with 1 contract and you're consistent, okay, then size up to 2. Once you get consistent with 2, go 2 to 3, 3 to 4, 4 to 5. And then as you continue to slowly size up over time, earn your size, become consistent with it, and getting used to using that size, that's when you can add more, and then you keep repeating the process. That's how you're going to build your position sizes larger. And once you build your position size and you allow your winners to run, you can slowly scale out of your position, move your stop losses up in hopes to catch a larger move. So with those 5 steps out of the way, let's hop on over to the charts. I want to break down my entire strategy from A to Z, and hopefully you guys gain a lot of value out of this. All right, so when I am trading, the main things that I trade are the S&P 500 futures, SPY, as well as QQQ and the NASDAQ futures. Now, every once in a while, I will take a trade on an individual stock. It just really depends on the setup and if the setup is something I want to trade. Like I said, most of the time, it's going to be SPY, ES, NQ, or QQQ. Now, with my trading strategy, a majority of it is just finding key levels in the market, seeing how price reacts to those key levels, and then taking a trade if it gives me my confirmation. Now, there are multiple different ways that I identify these key levels, but the main 3 that we are going to talk about in today's video is Fibonacci, supply and demand, and support and resistance. So let's start off with using Fibonacci. I do have an entire, I think it's like 45-minute video on my channel teaching you on how to use Fibonacci, and then also on top of that, I think I have a whole hour-long video showing you how to use Fibonacci. So make sure you guys check out those videos. I'll leave those links down in the description. But pretty much when it comes to using Fibonacci, you can only use it in a trending market. So we need to be setting either higher highs and higher lows, or we need to be setting lower lows and lower highs, which is going to be a downtrend. Now, when we are in a trending market, we can use Fibonacci to identify where these higher lows or lower highs are going to be. And that way we can identify a potential trade. So let's just start with this uptrend over here. Price is setting higher high, higher low, higher high, higher low. And like I said, using the Fibonacci retracements, we can identify where this higher low is going to be, look for an entry in this area, and then look for price to continue to the upside. So what we would do is we would take our Fibonacci retracement tool, we would identify the lowest point of price action and the highest point of price action. So the lowest point of price action before the large aggressive move was made, the highest point of price action before price started pulling back. Once you identify those 2 points, you can take your Fibonacci retracement, draw it from that pivot low to that pivot high. Now, personally, when using the Fibonacci retracements, I mainly focus on the 50 and 61.8% retracement. So then from there, when price trades down into that 50 or 61.8, I'm looking for some kind of bullish reaction, bullish hammers, bullish engulfing, long lower wicks, dragonfly dojis, but also an elevation in volume to tell me that there are truly buyers at these levels. Now, if I get that, that's where I will look for a long entry with my stop loss placed right below this low. Now, when price is in a downtrend where it's setting lower lows and lower highs, as price starts to bounce back up to the upside, we want to identify where that potential lower high could be to look for a short entry to then capture that next move down. So what we would do is we would identify the highest point of price action and the lowest point of price action before price started to bounce back up. So highest point before that first strong flush down, lowest point of price action before that bounce back up. And then from there, we can take our Fibonacci retracement tool, draw it from pivot low to pivot high, and then we want to look for price to trade into the 50 or 61.8. Now, when we get into this area, we are looking for bearish price action, bearish hammers, bearish engulfings, long upper wicks, gravestone dojis, and also on top of that, an elevation in volume to tell us that sellers are truly active in this area. Now, if we get that confirmation, we can then look for a short entry with a stop loss right on the opposite side. So a really good example of this could be found on IWM yesterday. This actually happened a little earlier in the day. You can see it better on a 2-minute, but we have this nice push to the upside. We top out and then we pull back. You can take your Fibonacci retracement tool, draw it from that opening low to that high point right there before price started pulling back. What happened? Pulled back to the 50% retracement, made a support, and then rallied into a new high of day. If we head on over to QQQ yesterday, I believe it was actually on the 16th. So I think that was either Tuesday or Monday. But if we head back on over here, here's our highest point of price action, very strong flush to the downside. Price ended up bouncing back to the upside, take our pivot high to our pivot low, and we can see that price came up right into that 61.8% retracement, rejected it pretty much to a penny, and that was the exact high before price sold back down and set a new low of day. So that's one way that I'll find key levels. I'll use this on higher time frames, lower time frames. It just really depends on where's our clear-cut pivot high and pivot low. Now, the second way that I'll find key levels, and this has actually been working really good in this current market environment where we're trading at all-time highs. So the next way that I find key levels is through using supply and demand. Now, a lot of people on YouTube, They'll explain supply and demand differently, but the way that I identify supply and demand levels is by finding areas where unfilled buy or sell orders are sitting in the market. And again, I'm about to show you guys how to find these. So to identify a demand zone, what we need to see is a small red candle. So here's our quote unquote small red candle. After that, what we need to look for is then a very strong move to the upside. So a very strong green candle. And I'll show you guys like real life examples of this here in a little bit. From there, we get our strong green candle to the upside. Because we have this small red candle and then a very large aggressive move away, there's going to be unfilled buy orders sitting in this area. So when price does come back down into those unfilled buy orders, we want to be looking for bullish price action to get long and then catch that continuation up. So now there's two different ways that we could potentially draw this demand zone. Let's just go ahead and add an upper wick to this. But what we want to do is we want to find the lower wick of that red candle and then the open of that red candle, which is going to be the top of this shaded red area right here. From there, you're going to take a rectangle and you're going to draw it from that low to the open of that red candle. And this is going to be your demand zone. So now the next time that price trades down into this area, again, we're looking for bullish price action in this area right here to then catch that continuation back up. Now, depending on this green candle right here, if this wick actually ends up being lower than this wick right here, instead, you're now going to take the demand zone down to the bottom of that green candle wick to the open of that red candle. So again, it's just going to change the area slightly. So that's how you're going to draw your demand zones. Now, as far as supply zones, what we're going to be looking for is we're looking for a green candle, a small green candle. And then from there, what we're going to look for is a very strong, aggressive sell-off to the downside. So as a result, this is going to leave unfilled sell orders in the market. So the next time price trades into this area, we're going to be looking for bearish price action to get short and then catch that next leg down. Now, just like this demand zone right here, we're pretty much going to take this and flip it upside down. So we're going to identify this upper wick on the green candle and the open of that green candle, so the bottom of the shaded area. From there, what we're going to do is we're going to draw this from that upper wick down to the open of that green candle, and this is going to be our supply zone. So now the next time price trades into this area, again, bearish price action, bearish volume is what we're looking for to get a short entry to then catch that next leg down. Now, just like this example over here, if this red candle's wick is a little higher than the green candle's wick, then just draw your supply zone from the red candle's wick to the open of that green candle. So if we go to the 4-hour time frame on QQQ, there's a demand zone right here. Here's a demand zone right here. Here's a demand zone over here. That's pretty much it for demand right now. Now, if we head on over to NQ, I don't know why it's showing a red candle right there. We'll pull up Thinkorswim actually. But if we head on over to NQ on Thinkorswim, here's a supply zone right here. Small green candle, large flush to the downside. That's supply. Same thing right here. Supply zone. Go to the 30-minute today on NQ. I told everybody to watch this level in the pre-market live stream. What do we see? Small green candle, large flush to the downside. As a result, this is a supply zone. What happened? Price traded into that supply zone. Break it down to a smaller time frame, 2-minute time frame. We rejected it, and that was the exact high today before price flushed all the way to the downside. So those are examples of supply and demand. Now, the third way that I find key levels is just basic support and resistance. Honestly, I don't take as many trades based off of support and resistance as I do with Fibonacci and supply and demand. Me personally, I find like basic support and resistance to be higher risk. Like, I make way more money trading with Fibonacci and supply and demand. So anytime I trade just basic support and resistance, I consider it higher risk, but I do still want to mark out those areas. So if we're looking at NQ right now, you can see that we have a wick here, a wick here, wick here, wick here, all these wicks over here. This to me is a strong support area, right? So now price finally closed below it today. But this, I would consider this support. So I would draw that on my chart. Or if we look over here, we can see that we have all these rejects right here, resistance here, 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 and then we finally broke above it. So as a result, I would draw this as a possible resistance zone until we break above it. And then once you break above resistance, it becomes support. Once you break below support, it becomes resistance. So a level that I actually was watching, like a couple of days ago for a potential reject, is you can see that we have a rejection off of this zone right here, support here, and then we broke below it. So I actually was interested in taking NQ shorts if price came up into this level right here, but unfortunately we did not come back up and test it. We just flushed even lower. But because this was previous resistance, turn support, break below support should become resistance. Break above resistance, it should become support. So those are the three main ways that I identify key levels. But then after that, all I do is break it down to a smaller time frame and look for a reaction at that level to confirm the trade. So again, if price is coming down to a support level, I'm looking for bullish price action and bullish volume. If I get that, I'll take the trade and use basic risk management. If price comes up to a resistance level, supply level, Fibonacci, whatever it may be, bearish price action, bearish volume. If I get that, I'll take the trade, use basic risk management. And honestly, that makes up 99% of my strategy besides a few intraday setups that I'll look for. But again, most of my trades are based off of higher time frame levels, supply and demand, Fibonacci, support and resistance, and then I just simply watch a smaller time frame when price gets to the level. Usually it's a 5-minute, a 2-minute, and a 15-minute time frame when we are trading at key levels. And again, if I get confirmation, I'll take it and use basic risk management. But that is going to wrap up this video on how to make your first $100,000 as a trader. As always, I hope everybody has an amazing rest of your day. And if you guys did find value, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. But yeah, peace.